Welcome to our exploration of international trade and investment, a fascinating area of global economics. In this session, we'll be exploring global economic interactions and how countries connect through trade. Now, let's examine the pillars of international trade that form the foundation of global commerce. International trade theories help us understand why countries trade, how they specialize, and how global resources are allocated efficiently. Two key theories, absolute advantage and comparative advantage, explain the benefits and dynamics of trade between nations, providing crucial insights into global commerce principles. Let's compare absolute versus comparative advantage to understand different paths to trade benefits. These concepts represent different approaches that countries can take to gain from international trade relationships. Absolute advantage, first defined by the economist Adam Smith, focuses on production efficiency. This idea was introduced by Adam Smith. It means a country can produce goods more efficiently using fewer resources than others. Based on this, countries should specialize in producing the goods they make best. Now, let's look at comparative advantage, which was developed by David Ricardo. This idea was introduced by David Ricardo. It emphasizes producing goods at a lower opportunity cost rather than absolute efficiency. This means countries can still benefit from trade, even if they are less efficient overall in production. Now, we'll examine real-world challenges to trade theories that go beyond idealized models. These challenges show us how actual trade differs from the theoretical models we've discussed. One major limitation involves simplified assumptions in traditional trade theories. These models often ignore complexities like imperfect competition and market power issues. Another challenge is that theories typically ignore transport costs entirely. They assume there's no cost to move goods globally, which isn't realistic in practice. Theories also assume resources are immobile between countries. This means labor and capital don't move between countries in these simplified models. Traditional models treat markets as static rather than dynamic systems. They don't account for how markets evolve and change over time through innovation. Finally, most theories assume no government interference in trade. They presume free trade without tariffs, quotas, or other trade barriers existing. Let's explore the balance of payments, which provides a global economic snapshot for nations. This system helps us track a nation's economic transactions with the rest of the world. The current account records several important types of international transactions. It tracks trade in goods and services, including both exports and imports between countries. This account also includes income flows like dividends and interest payments internationally. Additionally, it covers transfers such as remittances and foreign aid between nations. Overall, the current account reflects a country's net income from abroad activities. Now, let's examine the capital and financial account of the balance of payments. This account records ownership changes in financial assets across international borders. It includes foreign direct investment, where companies establish operations abroad. The account also covers foreign portfolio investment in stocks and bonds internationally. Finally, it tracks net lending and borrowing activities by the country globally. Now, we'll dive into understanding exchange rates and their crucial role in global trade. Exchange rates determine how much one currency is worth relative to another, playing a vital role in international trade and investment. They fluctuate due to various factors like economic conditions, interest rates, and political stability. Understanding these rates is crucial for analyzing global financial markets and assessing a nation's economic health, as they directly impact import costs and export profitability. Today, we're exploring how governments shape global trade through various policies and tools. We'll examine different types of government interventions in international commerce and their impacts. Let's start with tariffs, which are one of the most common trade policy instruments. Tariffs are essentially taxes imposed on imported goods coming into a country. These taxes increase the final prices of imported products for consumers. This helps protect domestic industries from foreign competition by making imports more expensive. Another important tool is quotas, which work differently from tariffs. Quotas establish specific limits on the quantity of goods that can be imported or exported. These restrictions directly control market availability of certain foreign products. However, quotas can sometimes lead to supply shortages and higher prices. Now let's consider trade agreements, which represent a different approach. These are treaties between countries that aim to reduce trade barriers and restrictions. By lowering barriers, trade agreements significantly increase market access for participating nations. They promote international cooperation and facilitate freer movement of goods and services. Now, let's explore foreign direct investment and its diverse pathways across borders. We'll examine how companies choose different methods to invest in foreign markets. First is greenfield investment, which involves building completely new facilities. This means constructing new operations from scratch in a foreign country. Next, we have mergers and acquisitions, commonly known as M&A. This approach involves acquiring or merging with existing companies in foreign markets. Joint ventures represent another important foreign investment strategy. In joint ventures, two companies collaborate to form an entirely new business entity. Finally, we have strategic alliances between international companies. These are partnerships for shared goals while maintaining independent company structures. Let's now discuss why companies pursue foreign direct investment and their strategic goals. We'll examine how companies optimize their investments for global growth opportunities. First is market-seeking investment, which focuses on accessing new customer bases. Companies use this strategy to tap into growing demand in foreign markets and expand their reach. Next is resource-seeking investment, which targets valuable inputs abroad. This approach helps companies obtain natural resources, affordable labor, or specialized expertise. Efficiency-seeking investment aims to improve operational effectiveness. Companies pursue this to achieve cost savings through lower production costs or favorable taxes. Finally, strategic asset-seeking investment targets valuable capabilities. This approach involves acquiring technologies, brands, or capabilities for competitive advantage. Now, let's examine the various factors that influence foreign direct investment decisions. We'll explore the key considerations companies evaluate before making global investments. Economic factors play a crucial role in investment decisions. These include market size, labor costs, and the quality of infrastructure available. Political and legal considerations are equally important for investors. Companies assess political stability, regulatory frameworks, and available tax incentives. Social and cultural factors significantly impact investment success. These include cultural similarities and understanding local consumer preferences. The competitive environment also shapes investment decisions. Companies analyze market competition levels and existing players in the industry. Let's now explore international financial institutions and their roles in global trade. We'll examine how these organizations shape the global economic landscape significantly. First, we have the WTO and IMF, two major international organizations. The WTO governs global trade rules, facilitates negotiations, and settles trade disputes between countries. The IMF promotes financial stability, provides monetary assistance, and offers economic policy advice. Both institutions work to stabilize the global economy for smoother trade and investment flows. The World Bank serves a different but complementary role in development. It provides long-term loans and grants for development projects in various countries. The World Bank focuses on poverty reduction, infrastructure development, and sustainable economic growth. It works to improve business environments in developing nations through various initiatives. Additionally, the World Bank offers valuable research and technical assistance programs. Let's review the key takeaways from our discussion on global trade and investment. These essential concepts form the foundation for understanding international commerce. Absolute and comparative advantage explain the fundamental economic drivers behind international trade. The balance of payments tracks all economic transactions between a country and the rest of the world. Exchange rates profoundly influence trade competitiveness and international investment flows. Trade policies like tariffs, quotas, and agreements shape market access and trade flows. FDI strategies enable global expansion by seeking markets, resources, or efficiency gains. International financial institutions stabilize the global economy and foster development worldwide.